Hello everyone, welcome to Infinity Concepts. I am Aadit Shah, your instructor, and we are in Financial Reporting and Analysis, chapter number 4. What is the fourth chapter? Understanding the balance sheet. Okay, we have already understood the income statements. Now we are understanding the balance sheet. Okay, what are we going to learn in balance sheet? We will be learning, we will introduce ourselves, then different type of assets that we are going to learn. Inventories, on the asset side, what all things do we have? Inventories, property, plant and equipment, intangible assets and financial assets. These are the four things, and the different types of liabilities are is what we are going to learn. So that is another thing. Common size balance sheet, the way we had also learned common size income statements, the same thing we are going to now learn, which is common size balance sheet. So we will go ahead and see, and the different ratios that we are going to learn, because balance sheet also has a lot of ratios, debt to equity ratio, and so many turnover ratios, liquidity ratios, and leverage ratios, and so on. So we will see what the different types of ratios are. We would have done at some or the other point of time during your level 1 curriculum, but no doubt we will also be seeing currently. Okay, so let us introduce ourselves to balance sheets, and you all know what the financial name for balance sheet is: statement of financial position or statement of financial condition. It is always as of a particular day, as at a particular date or day, right? The income statements were for a period, but balance sheet is always as on a particular date. Now, what are the components? The components are assets, liability, and the equity portion, right? If it is a T-shaped balance sheet, this is known as a T-shaped balance sheet. You can also have a balance sheet like this, okay, wherein first you have all the assets over here, and then you have all the liabilities over here, okay, everything. So this is not a T-shaped balance sheet. T-shaped balance sheet is like this, okay. It is simpler for us to understand and even to explain, and therefore we write the T-shaped balance sheet. But in reality, we usually follow practically, okay, we should follow this kind. No one shows a T-shaped balance sheet. Well, so this is your components of balance sheet. Your net assets are assets minus liability. So basically net assets is nothing but your equity, right? Equity, which includes even reserves and surplus, right? So both of them together. So assets minus liability is net assets, or you can also call it as equity. Fine. Now two words that we are going to remember. You already know that, because see, some or the other point of time we would have done this. In corporate finance we have learnt what the liquidity and the solvency is. Okay, at other in fixed income also we had learnt what the liquidity position and the solvency position is. Even in FRA we are now learning liquidity and solvency. So we already know, but I don't know right now whether you have first taken up FRA chapter this as a subject, or you have taken up corporate finance earlier also. So as I don't know which is the first one that you are taking up, if this is the first one, then I need to explain you liquidity and solvency as well. So we will quickly go through because this is not a big portion that we are going to cover right now. So I will quickly take this up. Liquidity position, ability to meet short term obligation is known as the liquidity position, and ability to meet long term obligations is known as solvency positions. And therefore when I want to highlight something as to this is say for example we want to say that Enron Limited is has solvency issues, if I say like that, or if I say that Kingfisher Airlines has a solvency issues, DHFL has solvency issues, it means that its long term ability to pay funds is very low, they are very weak. Okay, weak in what? Its ability to meet long term obligations are very low, will be known as solvency position. And liquidity position means what? Ability to repay its short term obligation is very low right now, which means they are facing some issues right now for the money. Okay, they don't but in a longer term maybe their solvency ratio, solvency position is very good, but only for the time being maybe the cash flow mismatch is very high, and they are not able to get money, or some bank lines are not open or something like that, and therefore in the short term maybe there is some cash crunch, But on a long term basis, the company is very strong. It is having lot of land parcels worth millions and millions of dollars in the outskirts of the city, and it will all of that can simply pay off all its debt. This is what we speak. So a company may have liquidity issues, but not necessarily solvency issues. My ancestors, my father, grandfather is very rich. Okay, so for me, whatever I do, small things, for me solvency issue is not there, liquidity issue may be there. My parents are not giving me money because they know I am a spoiled brat. I am a spoiled brat. I am actually just throwing away the money. I am just using the money for all the wrong uses and so on, and therefore my parents don't give me money. But in case anything happens to me, they are ready to always back me, right? This is what the main contention is, at least people who stay in family over here in India. So we know. So this is how we will be saying that this guy, me, okay, I am not like that, but I am just taking an example. I am a spoiled brat. So for me, if I don't have money right now, people will come and say that his liquidity position is very bad in the short term, but his solvency position is very high or very good. Why? Because in the long term, if anything happens to me and genuinely I need money, then for that my parents are always there as a backing because they are very rich. But they are not giving me money for all the wrongdoings that I do, and therefore that is known as my liquidity position is bad. So from a company perspective, when we say that from the company's perspective, if say for example in the short term, if they are unable to pay some money or there is some credit crunch or some cash crunch, then we say that liquidity position is bad. Only if in the long term they are not able to pay the money and the balance sheet looks very weak, they don't have anything on the asset side, on the liability side there is a huge liability, then we say that their solvency position is also very bad. Now, what is the different types of formats of balance sheet? Okay, there are two types of formats, classified format and liquidity based format, which means how do I place the balance sheet? Okay, how do I write on the balance sheet? One is a classified format, which means the whole balance sheet is going to be on the current and non-current bifurcation. Okay, so say for example current assets, non-current assets, current liabilities, non-current liabilities, all of these bifurcation, okay, whatever we do will be divided into current and non-current. Okay, now what do you mean by current? When will you put certain amount in current and when will you put it as a non-current? Assets and liabilities which are likely to be converted into cash within 1 year or one operating cycle is known as current, and those which will be taking more than 1 year to get converted into cash, that will be known as non-current. Okay, so when the whole balance sheet is converted into current and non-current, okay, current assets means all those amounts which are going to be converted into cash in 1 year. So your debtors, your stock, usually all of them that gets converted into cash within 1 year, they will be classified as current. Fixed assets and all will be non-current. Now liabilities also, whatever debt that you have taken, okay, say for example bank loan. Now bank loan is a debt that will be a part of your liability. Now will that be current liability or non-current liability? For that you will have to check. Whatever amount of the loan that you will have to pay in next 1 year, that will be considered as a current liability. Whatever that you will have to pay over the period of more than 1 year, all of that will be non-current. So identify which you will have to pay in 1 year, that will be current, rest all will be non-current. Same way creditors are usually current liabilities only because you have to pay them within 1 year. Like no one will have a credit period of more than 365 days, no supplier is going to allow you, right? You will also not allow your debtors, right, more than 365 days. So debtors also goes in current assets. Same way liabilities, creditors will also go in current liabilities only. So this is your current non-current bifurcation, which is known as the classified format. Okay, IFRS and US GAAP both allows classified format. Remember, IFRS so only allows classified format. Look over here, liquidity based format, which I will tell you, US GAAP allows liquidity based format, but IFRS doesn't allow, which means IFRS only allows classified format only, that is current non-current. So this is very important. You should know current non-current classification. Why? Because both of them are allowing. Okay, now what is US GAAP also allowing? I'll just spend half a minute on it. Otherwise, if this goes a lot of times in your mind, you will feel as if liability based format is very popular. But no, classified format is very popular, and therefore I spent a lot of time on this, so that in exam, even while studying, if you do not study this in your exam, you will remember that Aadit had told something like this, right. So you do not forget. So that is why I do all of these activities, so that you understand, even if you do not go through while you are at home, you can understand, you can just remember that yes, something Aadit had spoken during the lectures. Okay. So liquidity based format, only US GAAP, IFRS is not going to allow. What is there in liquidity based format? Order of liquidity to be maintained, mainly this is presented by banks. So in banks, what is the first thing? Maybe cash and cash equivalents will be the, cash will be the first thing, then cash equivalents will be the next thing, then some liquid securities will be the next thing, then some illiquid securities will be there, then property and land will be the next one, So in the decreasing order of liquidity, you will have to put down all the assets and liabilities. This is known as liquidity based balance sheet, only by banks, and that too only US GAAP is allowing that. Okay. However, our contention was more on the classified format, because this is what US GAAP and IFRS both of them allow. So this is what is your total format of the balance sheet. Okay. Now coming to the asset side, we are going to learn cash and cash equivalents, marketable securities, accounts receivable, that is debtors, and then when we go ahead, we will also be seeing inventories, long lived assets, and all of these things will be there, intangible assets, all of these will be seeing. Cash and cash equivalents, so short term and highly liquid investments are known as cash and cash equivalents. They are valued at amortized cost or majorly at the fair value. Fair value means the value which you are going to get for those cash and cash equivalents. So that is one thing. Marketable securities, easily sellable in the market. Say for example, some highly liquid mutual funds, some highly liquid sovereign debt, and all of them are highly liquid in nature, and that will be marketable securities. They are valued at current market price. Okay. This is one particular thing you need to know, the valuation. Okay. So cash and cash equivalents will be valued at amortized cost of fair value. Marketable securities will be valued at current market price. The next one is debtors. Now debtors are accounts receivable, they are valued at net realizable value, which means what is the net realizable value. Now it may so happen that some say for example, you may have $1,000 as debtors in your books of accounts. Okay, you can see there is $1,000 in your balance sheet. These are your debtors. Now when you actually go and collect this amount from the debtors, that is what the actual amount that you will be receiving. Say for example, out of $1,000, okay, your luck is very bad, you are actually very unlucky, okay, and $400 don't give you money. Okay, there are some people who don't give you money, but $400 you are only left with $600. Ideally for this there should be provision for bad debts that you would have already done. Okay, whether you have done provision or not is a different thing. $400 becomes your bad debts. Okay, this is your bad debts. Okay, whether you have done or not is a different thing. If you have not done, even if you are not done, but if you know from your heart that okay, $400 I am not going to get, then you are going to do provision for bad debts in your books of accounts, and $600 is what you will be showing in your balance sheet. This 600 is nothing but your net realizable value, because this is what you are going to realize, and therefore debtors are always valued at net realizable value. Net of what? Net of provision for bad debts. Okay, so your debtors are net of provisions, and therefore they are known as net realizable value. So it is valued at NRV, net of provisions for bad and doubtful debts. Correct. It's an unfortunate event. Okay, if this thing happens, business doesn't survive much. Like you cannot consistently have bad debts in your businesses. Like up to a certain limit, everyone has. Okay, like all the banks have credit cost. Okay, all the businesses also have some or the other kind of bad debts, but consistently if you have huge bad debts, then that is very bad. Well, we will move ahead. Next one is inventory costing. Now let me explain you one particular thing. What is inventory costing mean? Inventory costing means taking the cost of the inventory, that is taking or calculating the cost. Okay, cost is already incurred, But if you want to assign a cost, then what is the cost for that particular product or for that particular item or goods? That is known as inventory costing. So, standard costing by manufacturing company. So, standard costing which is used by manufacturing companies, and retail costing is used by trading companies, those who do trading. For them retail costing is required, and for manufacturing companies standard costing is required. Now, what is standard costing? Standard material cost, okay. So, your raw material cost plus standard labor cost. Remember the word that we are using over here is standard, okay. When we go ahead we will come to know what standard is. So, raw material cost plus standard labor cost plus standard overheads, okay. So, standard overheads means the overheads which you have already allocated. So, overheads allocated. So, all of them, your material cost, labor cost and overheads, all of this together becomes your standard costing, okay. So, say for example, if you have manufactured this pen, you would have manufactured thousands and thousands of pen, okay. Now, you want to calculate what is the cost of this pen, so that whatever the pens that remain in stock at the year end, closing stock, that you can value it properly. So, what is the value of this pen that remains in my stock? You have not sold it, right. If the cost of this pen right now is $100, I may sell this for, may say for example $300 in the market. I am having a huge margin. So what? But at what price I will keep this in my balance sheet? The closing value, what will it be, the closing stock value? The closing stock value for this one particular pen, for that I will have to calculate the cost. What will be the cost of this particular pen? Say for example, if mine is a manufacturing company, I have manufactured this particular pen, then there will be, say for example, material cost, the labor cost that has got involved, and also the overheads, standard overheads. Overheads are what? Overheads that I allocate to this particular pen. Say for example, the rent that I pay for this particular property, right, the salary, the wages I paid, that has already been included, but the rent has not been included, and so there are so many other costs which are not included. So, I allocate it to this particular pen, and therefore, the costing of this pen comes to $100, okay. And if it is a trading company, then for trading company my retail costing is going to be sales price minus gross profit, which is nothing but the purchase price only, na? What else it is? Sales price, say for example $300 is the sales price minus gross profit is $200 which I have kept. $100 is my purchase cost, or whatever the cost is, right. This becomes the cost, okay. So, this is how your standard costing for manufacturing company and retail costing for a trading company going to be, okay. Now, this is what your inventory costing going to be, cost per pen, okay. This is what per pen cost is going to be. Now, we will go ahead and we will say inventory costing based on standard costing. We are moving into little bit more detail. Now, all the product cost needs to be included, but period costs are always going to be excluded, okay. The unallocated portion of the period cost will definitely get excluded. All the product cost is going to be included. So, when I am manufacturing this, remember standard costing is only used by manufacturing company, okay. So, for a manufacturing company standard costing is going to be used, and for standard costing what all things we are going to do? Product cost is going to be included. What do we have in product cost? We are going to have purchase cost, conversion cost. So, conversion cost means all the labor cost and all the other things that are required. So, labor, wages, and all that cost is the conversion cost to convert this from raw material to this particular pen. So, whatever the labor cost etc. is, that is the conversion cost. Pre-allocated fixed overhead. Say for example, rent is something which is your pre-allocated fixed overhead. Say for example, the rent is $10,000 per month, and in 1 month I am going to manufacture 1000 pens, okay. This is what I have forecasted. In reality, I can manufacture maybe 1100 pens also or 900 pens also, I do not know, but forecast is 1000 pens that I have already thought in my mind. I have forecasted. This is what I have forecasted. The rent for the month is 10,000, and therefore we see that $10 is the overhead per pen. this $10 overhead is known as the pre-allocated fixed overhead. That pre-allocated fixed overhead also needs to be included over here in your product cost. Okay. So, I am just calculating the cost of this pen. So, purchase cost of raw materials, so standard material cost, standard labor cost, pre-allocated fixed overheads, and also cost to bring the inventory to the current location. So, to bring this inventory to the current location, whatever costs have been involved, okay, that also needs to be included over here. Okay. So, this is what your product cost is. Now, what you do not need to include is, okay, unallocated fixed overheads. Okay. Say for example, after doing this your cost comes to $100 for this pen. Okay. Now, unallocated fixed overheads, what do you mean by unallocated fixed overheads? Your rent was 10,000. Now, you know what happened? In reality, you could produce only 500 pens. How much you could produce? Only 500 pens. I do not know what, something wrong happened and you could produce only 500 pens, which means now your overheads per pen is $20 and not just $10 which you had calculated earlier. Now, it is $20 per pen, right. So, you should have included actually 20 over here and not 10, but that is what you came to know after 1 month, right, when you had produced 500 instead of 1000 which was forecasted earlier. So, now later on you can't do anything. Now, you can't come over here and put 20. Whatever you had put 10 last time, that only is what you will have to put. This is what is known as unallocated fixed overhead. We could not allocate the full 20, we could allocate only 10, which means rest 10 got unallocated. That unallocated portion of the fixed overheads should not or cannot get loaded into this particular cost that you are calculating for the particular pen, right. So, unallocated fixed overheads will not be included because that is a period cost. Abnormal wastage, over here we saw abnormal wastage, instead of 1000 pens, 10 pens were defective and therefore only 990 pens were got manufactured, right. So, for the cost for that another 10 pens, that will also not be included or get over, it will not get spilled over on these pens, right, the 1000 pens that I have manufactured, right. Storage cost, storage of final inventory, that is your finished goods. Storage of finished goods will not be included over here, and admin, selling and distribution overheads, that will also not be included in the costing of this particular pen. Okay. So, this is what your period cost is. Period cost will not be included. So, all of these things you do not have to include. Okay. Once again, because this is important, I am going to again repeat what is going to be included in the calculation of this particular pen's cost. Okay. So, it is just an elaboration of the previous slide that we saw. Standard material cost, standard labor cost, pre-allocated fixed overhead which is your standard overhead, and cost to bring inventory to the current location. Okay. The raw material and inventory which you bring to the current location, whatever the cost has been involved till that particular point of time, that is going to be included. The cost that you involve to move your finished goods from one location to another, that will not be allowed. Yes, if you are moving your raw material from one location to another, that will be allowed, okay, but not the finished goods. So, till this point of time, this is what is we are going to include. Now, period costs which are to be excluded, what are these period costs which will be excluded? The period cost which gets excluded is unallocated fixed overheads, that will be excluded, abnormal wastage, that will also be excluded, storage cost will be excluded, storage of fixed goods, okay, finished products, storage of finished products, that will be excluded, storage of raw materials will be included, okay, of fixed goods only, fixed products, finished products will only be excluded, and admin, selling and distribution overheads will also be excluded, right. So, these are the period costs which will be excluded. Fine, we will move ahead. Well, now valuation of inventory. Now, I will explain this valuation of inventory and then I will explain you something, doubt of which I always used to have when I was studying. Okay. So, years back when I was studying, many years, 7, 8, 10 years back, when I was studying this particular thing, I had this doubt, but this doubt did not get solved somehow. Now today I am going to explain you so that you all don't have this doubt. Okay, so this is the sweetener for you all. I'll explain you very well. First I'll go through the what is the valuation of inventories, and once we complete valuation of inventory, I'll tell you what all of these things is. The standard costing we saw, we also saw a different expense recognition like FIFO, LIFO and weighted average method and so on, you like specific identification method and so on, that is the expense recognition. And then we are also having this valuation of inventory. So many things. What is all these things, right? What to use when? One side there is costing, one side there is expense recognition, one side there is valuation. Then what is expense recognition? And otherwise then what is the standard costing if this is valuation? Then something getting confused what all these things are? No doubt, even I used to get confused, but I am going to explain you, because you should not remain confused while you go in the examination. Okay, when you go in the examination, you should be the best amongst all the others, right? So let us first go to the valuation of inventories. Okay, valuation of inventories or closing stock. Now there is a difference as per IFRS and US GAAP. Remember, US GAAP allows LIFO, no one else allows LIFO, okay, which means IFRS does not allow LIFO. Who else? It is only two things, IFRS and US GAAP, two things we are learning. Are we learning iGAP? Are we learning Korean GAAP? Are we learning Chinese GAAP? Are we learning Singapore GAAP? Are we learning anything else? No, we are doing this, right? So IFRS and US GAAP, only US GAAP is allowing LIFO, and US GAAP also allows other things, okay, but US GAAP apart from others, it is also allowing LIFO, and therefore for LIFO, which only US GAAP is allowing, for that there is a different way of calculating valuation of inventory or closing stock, okay. But for all the other things, that is for all the other three apart from LIFO, the other three, which means all the four types of IFRS, all the three types of IFRS, which is specific identification, weighted average and FIFO, okay, and US GAAP also FIFO and specific identification. So all the three of them, okay, we are going to use this particular method only. Now what that method is, how to value the closing stock. So the closing stock is valued at cost, which you found out just recently, okay, cost, or net realizable value, whichever is lower. So if the cost is $100, net realizable value is $110, then the cost or value of the closing stock or value of inventories in your books of accounts will be $100, correct. Now NRV is what? Selling price minus selling cost. If say for example you are going to sell it for $130, this particular pen, and the selling cost is $20 per pen, okay, per this pen $20 is what is going to be your selling cost. So 110 is your selling net realizable value. This is what you are going to realize on each pen. Your cost is 100, your net realizable value is 110, whichever is lower will become your valuation. So it will be 100. This pen will be valued as closing stock in your balance sheet, as well as it goes in your income statement, okay. In your income statement also it goes, right. It is a part of COGS. Your closing stock is also a part of COGS. Opening stock plus purchases less closing stock gives you COGS, correct. This is what it is. Now US GAAP LIFO. What do you mean by LIFO US GAAP? Only LIFO is going to allow this particular thing that we are seeing, okay. So what this particular thing is, cost or market value, whichever is lower. Remember over here we are seeing market value of this particular pen. So cost or market value, whichever is lower. This was the market value. Now what is market value? Market value is going to be replacement cost, which should always be between NRV and NRV minus profit, okay. Now something important, again speak this thing, okay. You will have to memorize this thing, there is no other way out, okay. As per US GAAP LIFO, okay, only LIFO, and LIFO is only allowed in US GAAP. So no use to again and again spell US GAAP, okay. LIFO as per LIFO, the valuation of closing stock is going to be cost or market value, whichever is lower. Now, what is market value? Market value is the replacement cost. The replacement cost is the amount at which this pen can get replaced in the market. In case this pen gets lost, then you will have to buy a new pen from outside. Just as an example, at what price will you be able to buy this pen from outside? That is known as the replacement cost. Okay. So, replacement cost has to be between NRV and NRV minus profit. If this is the replacement cost, okay, then the replacement cost will not be taken as this, that is the market value will not be taken as this, it will be maximum taken as NRV minus profit. If replacement cost is, say for example this, then replacement cost will not be taken as this, that is the market value will not be taken as this, it will be taken as this value, okay, the NRV value. So, it means that we will be taking a sum when we go in long lived assets and inventories chapter, okay, not long lived assets, inventory chapters, we will be using this particular formula, we will also be doing sum on this particular thing. So, cost or market value, whichever is lower. What is market value if someone asks you? That market value is the replacement cost, and that replacement cost will have to be between NRV and NRV minus profit, fine. So, now we will go ahead. If inventory value is written down, remember inventory value can be written down, say for example cost is 100 and net realizable value is, say for example 80, then you will have to write down, right. Your inventory will be written down because it is the cost at which it is currently staying in your balance sheet and in your P&L also. Now, actually in reality what happens is that your value, net realizable value is 80, and therefore you will have to write down your inventory, and therefore if inventory is written down, loss is recognized through the income statement. Where is it recognized? In the income statement. Now, a fundamental thought in your mind is, okay, you will always remember this, IFRS is always going to allow reversal of the write down subsequently. US GAAP is not going to allow. US GAAP is very stringent and very strict. Once you have written down the amount, now it will not be allowed to be reversed. US GAAP, even when we go to depreciation, where we do impairment, reversal of impairment, US GAAP is not going to allow. IFRS is going to allow. Even over here, reversal of write down for inventory, IFRS is going to allow, US GAAP is not going to allow. I told you, IFRS is principle based. It will go on the principles. If you subsequently feel that no, NRV is not 80, the NRV is 100 only, or NRV is net realizable value is 110, this is what you find out later on, okay. You have already written down the value to 80, after next year you still have this pen in your closing stock, at that point of time the net realizable value is 110, the market value rose, just as an example. Now the NRV is 110, so you will have to bring back the amount, you cannot go back to 110, you can maximum reach till 100, because that is what the write down that you have done per pen, $20 of the write down that you have already done, you want to reinstate that. Now, if you are using IFRS, IFRS is going to allow you to reverse this particular $20 the write down that you had taken last year. This year IFRS is going to allow you, but IFRS is going to allow you, but US GAAP is not going to allow you. US GAAP does not allow subsequent reversal of the write down. Once done, that is done and dusted as per US GAAP. It is very strict, it is very rule based. IFRS for that matter is very genuine. It will allow fair valuation. If in reality the value of this particular pen, the NRV has gone up to 110, so that was a mistake maybe you did last year. It was not even a mistake, it was a genuine thing that required to be done last year, because last year the NRV had fallen down from 100 to 110 to 80, and therefore if cost was 100, NRV was 80, IFRS did say that you do cost or market whichever is lower, and therefore we wrote it down to 80, correct. And if say for example next year now this value goes from 80 to again 110, so whatever is the balance that you have taken a $20 hit, a write down, that needs to be reinstated. IFRS will allow you to take back in the income statement. Remember, management always want more income, because management's bonuses are linked to the profits of the company, and therefore what do they require? They want subsequent write up to be allowed. If it is US GAAP, that will not be allowing, and IFRS is going to allow. Same is going to happen to for 3-4 other places we are going to see. Even impairment, reversal is not going to be allowed by US GAAP, IFRS will be allowing reversal. Okay. Even in future other 2-3 places also we will be seeing IFRS allows many of the things, US GAAP is very much rule based, it will not allow so many other things. We will see that when we go ahead. Okay. Now let us move ahead. Property, plant and equipment, which is long lived assets or fixed assets. We also have a chapter on this long lived assets when we go ahead. In popular language we call it fixed assets, in the finance language we say long lived assets. Okay. IFRS allows cost and revaluation method, US GAAP allows cost method only. Now what do you mean by cost method and what do you mean by cost or revaluation method which IFRS allows? Remember, IFRS is more principle based, US GAAP is more rule based. Okay, no deviation allowed. This is the rule. If you don't follow the rule, you will be given a stick and you will be hit with a stick. This is what US GAAP says. IFRS is a very chilled guy. IFRS says whatever is good, whatever looks optically well, whatever in reality is the fair thing that you need to show it to the public, to the shareholders, that is what you show. And therefore, it allows cost and revaluation model both. Okay. So, just on a lighter note, also IFRS shows most of the thing based on fair valuation. Okay. Whatever is the real value of that product, that will be seen in the balance sheet. Okay. US GAAP is not like that. US GAAP not necessarily shows everything at the fair value. Just see over here, as per US GAAP, all the assets needs to be shown at a historical cost, that is on the cost method basis. Cost method only means what? Cost method means if there are your assets are there, you have bought the asset for $1,000, there has been accumulated depreciation of 400, then 600 is going to be your net assets. Okay, gross assets are 1000, accumulated depreciation 400, net assets is 6000. Now say for example the value of this 600, the value of this 600 which is your net assets, if the asset value has actually increased, okay, there is more demand for that, and maybe even though you have used this product, the value of this asset say for example is 750, then US GAAP is not going to allow to revalue it upwards, but upward revaluation is allowed as per IFRS. IFRS is going to say that, well, if in reality the price of this particular asset is 750, then why not show it as 750? Why are you so much stringent in showing only 600 and going by the rule? Don't go by the rule. Show whatever genuinely it is. If this asset currently is in the market is worth $750, then there is no use showing it 600 to the stakeholders, okay, whoever is reading the financial statements. You show it $750. This is what the thought process of IFRS is, and therefore it goes more on the fair value terms, and therefore IFRS no doubt is allowing cost method also, but it gives full flexibility for people to even use revaluation model or revaluation method for long lived assets. If you are in IFRS, that is if you are making your balance sheet, if your financial statements, or if you are making or your accounting policy is IFRS and you are using revaluation model, then you can always revalue upwards, revalue downwards at any given point of time. Okay. So that is one thing. Or say for example the value of this asset, even though in your books of accounts it is 600, right, by doing accumulated depreciation, one fine day you feel that no yaar, this particular asset you will not be able to sell for 600, the value of this is only 400. You can revalue it, in fact you can revalue it downwards, which is 400, take another additional $200 write down and make this as 400 in your balance sheet, which US GAAP is not going to allow, IFRS is going to allow. Remember, if there was a change in business environment altogether, then we would have done impairment, we would have checked for impairment, what is the value of this particular asset. If it was 400, we would have written this down as impairment. But because there is no change in external or business environment, we are not doing impairment, but outright we are just finding the value of this asset and we feel it is 400, and therefore we will write it down to 200. Correct. Now this is what your cost and revaluation method is. Cost method, historical cost minus accumulated depreciation. Revaluation method, revaluation is allowed always, can be upward or downward revaluation. I hope you all are understanding things well. Okay, wait for it because we have a whole chapter of long lived assets that we will be seeing later on. Okay. Now what do you mean by investment property? Remember, investment property means assets that generate rental income or capital appreciation, that is known as investment property. Okay. If say for example any of the assets that you have taken for rental income or capital appreciation, then that will be an investment property, otherwise not. Say for example you have bought a home for use purposes or commercial property for business use purposes, not for rental income but for to do your own business, okay, not for capital appreciation but for your business, then that will not be called as your investment property, that will be your normal assets, your long lived assets or fixed assets. But if say for example you are buying a particular property just because you feel that in future the price of this property is going to rise, maybe a train station or a bus station or bus stop is going to be constructed nearby, you know, something like that. If you feel that the price of the property is going to rise and also in the meantime you will be earning rental income out of it, if that is your thought process, then classify that property as an investment property. Okay. So that is your investment property. Remember, IFRS allows this as a bifurcation, US GAAP does not have this classification at all. US GAAP considers all the particular asset or all the particular properties as a normal property, no bifurcation over there. IFRS is going to allow this bifurcation. Also I told you IFRS is going to show you what the real picture is. In reality, you understand that this is a normal property and this is an investment property, and this bifurcation is going to be allowed by IFRS. US GAAP is not going to give you any such bifurcation. There is no particular you know, rule or no particular bifurcation itself in US GAAP. Okay. So this is very important, and even if sometimes you get confused, think by this logic. US GAAP is not going to allow anything to be done apart from the rule. IFRS will allow what genuinity is, on a fair value basis it is going to allow you something. Fine, we will move ahead. Then there is also an impairment in the long lived assets. As I told you, impairment needs to be checked only when there is a change in external business environment. However, for goodwill we are going to check for impairment, or we are going to test for impairment at least annually. You can do it a shorter period as well, okay, but at least annually people do it, okay, and which is what is required. So what do you mean by impairment? I already told you, impairment is if say for example your carrying amount, the amount which is there in the balance sheet, okay, for the assets, if that is more than the recoverable amount. What is the recoverable amount? The recoverable amount is fair value of the asset minus the selling cost, which is what you will the amount that you will get in case you sell away the asset. So fair value of the asset minus the selling cost, that, or value in use, that is by using this particular asset, what is the money that you are going to generate, or what is the profits that you are going to make. Okay. So if say for example the carrying value of the asset in the balance sheet is $100, okay, and recoverable amount is something. What will be the recoverable amount? Say for example fair value of the asset is the say for example the fair value of the asset is $105, okay, you can sell the asset for $105, but you will also be having a cost of 15 on it. So $90 is the fair value minus selling cost, okay. And value in use, what do you mean by value in use? That is by regularly using this asset, obviously you will use the asset to manufacture or produce something, okay. From whatever the produce you make, there will be certain profits outside, right, from the produce or the goods that you produce or make, right. So by using this particular asset, what is the profit that you are going to generate? That is what you will have to calculate. So value in use is that, okay, discounted present value, okay, present value of the discounted cash flows, okay, whatever you get. So that is what your value in use. If say for example your value in use is 95, right, then higher of these two, obviously then you will not sell the asset right now for 90, right, because you are going to make a profit of 95 by using it. If by using it your profit is say for example 80, then it is better that you sell right now only for 90, like you sell it for 105, incur an expense of 15 so that you get 90, because by not selling and keeping that in use you are actually having or getting 80. So you are not going to use this particular asset, you are going to sell it away. But say for example if your value in use is 95, then 95 or 90 whichever is higher, 95 is higher, recoverable amount is lower than the carrying amount, and therefore we are going to impair this particular asset by $5. Okay. Now remember, this is what impairment is, and therefore IFRS is also going to allow subsequent reversal of impairment. US GAAP is not going to allow. US GAAP says once done, it is done and dusted. Why did you come back again to reverse the impairment? But then IFRS is going to allow reversal of impairment. Say for example, there was COVID situation right now and we thought that discounted cash flows are not going to be much, fair value and selling cost had also substantially fallen down, and therefore we saw all of these things over here, right, and this recoverable amount went down. But after COVID situation, what happened is value in use increased, fair value of the asset also increased, okay, this became 105, this become 110, right, and therefore recoverable amount is 110, carrying amount is 100, right, and therefore subsequent reversal of the impairment, this is going to be allowed by US GAAP. Last time what had we done? We had taken a $5 hit, right, impairment. This $5 needs to be again reinstated back, correct. So now that will be allowed under IFRS, but US GAAP is not going to allow. Fine. So next one we will move. Before that, let me just explain you that I was going to tell you for inventories. Okay, inventories, you will have to remember one thing. Inventories, you are going to start with standard costing of the inventory as to what is the value of this particular pen. Okay, the value, the cost of this particular pen, per pen, what is the cost of this particular pen. Okay, say for example in the month of January that I produced, the pens were worth 8. Okay, the lot, the month of Feb, the one that I produced were for 1 pen for 9 each, then for 10 each, March, April also 10 each, and May also 11 each. This is the value. Now obviously I am also going to start selling every month. Okay, if I am, this is known as standard costing. This is through standard costing I found out, this is the costing. Through standard costing I found out what is the value or cost of each and every pen. How did this 8 come? 8 came because of standard material cost, standard labor cost, the allocated amount of fixed overheads, and when you move from one to another location to bring the cost involved to bring the inventory to the current location, all these 4, okay, the product costs that are included to come to a final $8 per pen, right. This is what the standard costing is. Then what is your FIFO LIFO going to do? This is expense recognition, first in first out. Okay, this is your first in first out. So if say for example you are also selling the pens in that lot, then first in first out. If you are in directly in the month of March, if you are selling pen, say for example you sell 2 pens, so this will go away, March month's produce will remain. Then in April you sell 2 more pens, this will also go away, right, and then in May you are not selling anything. So 11 is what your closing stock is going to remain. This thing that you did was your FIFO method. If it was LIFO method, what will happen in last in first out? Whichever the last was in, that will go out. In the month of March you sold 2 items, so this will go away. Then in the month of April you again sold 2 items, so this will also then go away. If you had sold 1 item, then only this would go away, right, only this 10 would go away. This is how the cost is going to be. Then for 2 items the cost will be 11 and 8, which is 19, right. So this is what your LIFO is. If it was your FIFO, then 21 would be the costing, right. So that is what is also going to help you in costing. We will again do this when we go to the inventories chapter. Okay, you don't need to worry at all. Those who understood, well and good. If not, definitely there is a whole new chapter, okay, when we go over there. So that is your expense recognition. and this is what you are going to do through LIFO, FIFO, LIFO, FIFO, specific identification, weighted average costing, and so on, right. Once you come to this particular, say for example 21 is the cost of your particular value of the stock. Now cost is your 21 for 2 pence, right, and NRV for those 2 pence is 20, cost or NRV whichever is lower. This is what we did for the valuation. This is what you are going to do in valuation. This is also what we have learnt later on. Cost or value whichever is lower. Value is lower, NRV is lower, and therefore this is what your value of the goods going to be there in your closing stock. You will have to do a write down. What will you do? You will do a write down because cost is 21, your NRV is 20, and this is what your write down is going to be. Fine. Well, this was a short thing that what all things we have done, all the 4 of the things I have listed down over here. Okay, we'll move ahead. We'll move ahead to